What's up everybody, it's Pablo, and welcome back to the channel. Today we're diving deep into a topic that's absolutely crucial for any investor, diversification. Now you might be thinking, Pablo, I've heard about diversification before. Isn't it just about buying different stocks? And yeah, that's part of it, but it goes so much deeper than that. In 2024, with the market more unpredictable than ever, having a truly diversified portfolio is the key to weathering any storm and coming out on top. We're going to break down 10 powerful diversification techniques that can take your portfolio to the next level. Make sure you stick around until the very end, because I'm sharing some bonus tips you won't find anywhere else. Now let's get started. First up, we gotta talk about asset allocation. Think of this as the foundation of your entire investment strategy. Basically, it's about dividing your money across different asset classes like stocks, bonds, and real estate. You know me, I'm all about that real estate life. But seriously, the magic of asset allocation is that different assets tend to perform differently in various market conditions. When stocks are booming, bonds might be chilling out, and vice versa. This is called a negative correlation, and it's your best friend when it comes to managing risk. By spreading your investments across different asset classes, you're essentially creating a safety net for your portfolio. If one asset class takes a hit, the others can help cushion the blow. This means smoother returns over the long term, and let's be honest, who doesn't want that? The bottom line is, don't put all your eggs in one basket. Diversifying your assets is like having a financial airbag in case of a market crash. Trust me, you'll thank me later. Okay, so we've got our asset allocation locked in, but we're not done yet. Now it's time to zoom in a little closer and talk about sector and industry diversification. Even within a single asset class like stocks, you can diversify further by investing in companies operating in different sectors of the economy. Think about it: technology, healthcare, energy, consumer goods. These are all distinct sectors with their own unique growth drivers and risks. By investing in a mix of sectors, you're essentially hedging your bets against any single industry taking a downturn. But if you had diversified across other sectors like healthcare or consumer staples, which tend to be more stable, you would have softened the blow. Remember, a diversified portfolio is a resilient portfolio. All right, we've covered asset allocation and sector diversification. Now, let's take this global, baby. International investments are a crucial piece of the diversification puzzle, especially in today's interconnected world. Think about it. The US stock market is massive, but it doesn't represent the entire global economy. By investing internationally, you're tapping into new markets, different currencies, and a whole other level of growth potential. Emerging markets, for example, can offer incredible opportunities for growth, although they also come with higher risk. On the other hand, developed markets can provide more stability and diversification. Your portfolio will thank you for it. So far, we've mainly talked about stocks and bonds, which are great, but let's get a little more creative, shall we? Asset class diversification is about thinking outside the traditional investment box and exploring alternative assets that can add another layer of protection and growth potential to your portfolio. Real estate is a classic example. I mean, you guys know how much I love real estate. It's a tangible asset that can provide rental income, appreciation, and a hedge against inflation. Then you've got commodities like gold and silver, which can act as a safe haven during economic uncertainty. And let's not forget about the exciting world of digital assets like cryptocurrencies. Just remember to do your research, understand the risks involved, and as always, diversify, diversify, diversify. All right, let's dive back into the stock market for a minute and talk about growth versus value stocks. This is another important aspect of diversification within your stock portfolio. Growth stocks are like the Ferraris of the stock market. They're companies that are growing at a rapid pace, often reinvesting their profits back into the business to fuel even more growth. Think tech companies, innovative startups, the next big thing. Value stocks, on the other hand, are more like the reliable pickup trucks of the stock market. They're often well-established companies with a solid track record of profitability and dividend payments. They might not be growing as fast as growth stocks, but they can offer stability and potentially undervalued opportunities. The key is to find the right balance between growth and value stocks in your portfolio. This will depend on your risk tolerance, time horizon, and investment goals. By diversifying across both growth and value stocks, you're essentially capturing different segments of the market and positioning yourself for potential gains in various market conditions. Now that we've covered different asset classes and investment styles, let's talk about the vehicles you can use to actually invest your money. ETFs and mutual funds are like the SUVs of the investment world. They allow you to effortlessly diversify across hundreds or even thousands of stocks or bonds with just one single investment. ETFs, or exchange-traded funds, trade on stock exchanges just like individual stocks, making them super liquid and convenient to buy and sell. Mutual funds, on the other hand, are professionally managed by fund managers who make investment decisions on your behalf. Both ETFs and mutual funds offer instant diversification and can be a great option for investors of all levels, especially beginners. Beyond ETFs and mutual funds, you can also explore other investment vehicles like index funds, target date funds, and even robo-advisors. All right, so you've put in the work, built a diversified portfolio, and you're feeling good. But here's the thing. Diversification is not a one-time event. It's an ongoing process. That's where portfolio rebalancing comes in. Over time, as your investments perform differently, your initial asset allocation can drift. Maybe your tech stocks have skyrocketed, throwing your portfolio out of balance. Rebalancing is like hitting the reset button and bringing your portfolio back to its original target allocation. This might involve selling some of your winners and reinvesting the proceeds into other asset classes that have lagged. Think of it like this. You're locking in profits and reallocating your capital to areas where there might be more potential for growth. Rebalancing helps you stay disciplined, avoid emotional decision-making, and keep your portfolio aligned with your long-term goals. All right, we've talked about a lot of different diversification techniques. But for those of you who really want to take it to the next level, let's talk about alternative investments. Now, alternative investments are not your typical stocks and bonds. They're assets like real estate, private equity, hedge funds, commodities, and even collectibles. The beauty of alternative investments is that they often have low correlation to traditional asset classes, meaning they don't necessarily move in the same direction as the stock market. This can provide an extra layer of diversification and potentially enhance your portfolio's risk-return profile. They're not for everyone, but if you're an experienced investor looking for ways to further diversify your portfolio, alternatives might be worth considering. Now, who doesn't love passive income? Dividend-paying stocks are like the gift that keeps on giving. These are companies that distribute a portion of their profits back to shareholders in the form of dividends, typically on a quarterly basis. By including dividend-paying stocks in your portfolio, you're not only benefiting from potential stock price appreciation, but also generating a steady stream of passive income. This can be especially beneficial for investors looking for current income or those approaching retirement. When selecting dividend-paying stocks, it's important to look beyond just the dividend yield. You want to make sure those dividends are reliable and have room to grow over time. And finally, the most important diversification technique of all: continuous education. The investment landscape is constantly evolving, with new trends, technologies, and opportunities emerging all the time. To stay ahead of the curve and make informed investment decisions, you need to be a lifelong learner. Read books, listen to podcasts, follow industry experts, immerse yourself in the world of finance, and make it a habit to continuously expand your knowledge. The more you learn, the better equipped you'll be to navigate the complexities of the market and make smarter investment decisions. So, stay curious, stay informed, and never stop learning. There you have it, folks, 10 powerful diversification techniques that can help you build a stronger, more resilient investment portfolio in 2024 and beyond. Remember, diversification is not just about avoiding losses, it's about positioning yourself for long-term financial success. If you want to dive even deeper into these strategies, I've got a ton of free resources on my blog, including in-depth articles, case studies, and even downloadable templates. As always, thank you so much for watching, and remember to like, subscribe, and hit that notification bell so you never miss an upload. Until next time, stay informed, stay invested, and keep crushing it.